get some thoughts from Kieran Quain, who joins us from VIG Securities this morning. Also, Sally Old, interest rate strategist from JP Morgan, and Carson's with me in studio as well this morning. Sally, just kicking off with you. The market's moved quite a lot on these comments from Stevens yesterday. Do you think the market's overreacted?
I mean, I think they were clearly very hawkish comments by the RBA governor yesterday. And, you know, when you have a central bank governor that comes out and says, we don't think inflation's going to fall any further and we think the economy is going to grow above trend in 2011, and you know that the setting of monetary policy is firmly neutral, then it's pretty clear that that means one thing and one thing only for the direction of interest rates. So I think the market was caught a little bit by surprise by those headlines. People sort of thought, oh, Stevens is speaking out in regional Victoria. He's speaking to a group of people whose main aim in life is all about regional renewal in Australia. So I don't think they expected him to say so much that was going to be so relevant to the front end of the Aussie curve. So we did see a pretty significant repricing yesterday. That was encouraged overnight by some additional commentary from a couple of well-known RBA watchers saying that, you know, there's a good chance of an October rate hike. So I don't think the market has overreacted to what Stevens said, because he was pretty clear about where rates were going. And I think there's a slight tactical advantage to actually lifting rates in October, which is that you don't have to sort of tie yourself to the quarterly inflation numbers. So, you know, a lot of people got into the habit of thinking, because that's what they did a lot in the last tightening cycle, it was wait for the inflation number. It usually printed stronger than they expected. That forced them to raise interest rates, and so it sort of got them into this pattern of raising rates once every quarter. If they go in October, they just didn't disconnect themselves from that whole dynamic, and it means that regardless of where the inflation number prints, if it prints high, if it prints low, if it prints on expectations, it doesn't matter, because they've already got a rate hike in the system.
Do you buy this one, Kieran? I mean, would they sort of depart from best practice just for the sake of just surprising everyone, or would there be more to it?
I don't think there's any surprise anymore. I mean, the comments were very hawkish, so an immediate move in October is possible. Even another move in November is also possible, 2 times 25 basis point moves. But the market pretty well predicts more likely November than otherwise. That's the pricing at the moment.
So we saw some of those bond yields quite a bit higher. Was Stevens the only thing behind that?
Well, effectively, the last jump in bond yields has been as a result of the speech. Okay. Pretty much the bond market had been, in response to stronger economic data over the course of last month, employment data and GDP, etc., had lifted bond yields, and the latest round was immediate following the governor's speech, and pretty much in response to the very hawkish comments, above trend growth, capacity constraints, and blatantly a possible need to raise interest rates to accommodate.
It's very interesting, you know, back to you, Sally, just this idea of the contest now for all this debt that's being issued globally. We had Moody's and another rating agency quite bullish on the UK's austerity, which, if anything, implies not more stimulus, no need to sort of add to the debt burden. Do you think that that's going to prove a more attractive destination for bond investors as a result than, say, the uncertainty of the US position? And how do we stack up?
Well, I think there's no doubt that the Australian situation is fine. I really don't think we have to worry about that. And when you talk to people offshore and they sort of ask questions about, you know, what's the deficit in Australia, what's the net debt in Australia, as a percent of GDP, they almost sort of laugh, because it's so small compared to some of the magnitudes we're seeing in European and US and Japanese economies. I think what's going on at the moment is there's quite an interesting dynamic. Like, if you look at the sort of European peripheral economies, you can sort of see there's been a bit of a decoupling. So just lately, Portugal and Ireland have been the two sort of markets that have really underperformed. Ireland in particular, as there are obviously concerns about, you know, the demands of the banking system on public sector finances there. But interestingly, you know, Spain has actually outperformed, and they got some significant bond issues away last week at very good yields and were very well received by the market. So, you know, one of the reasons that people are saying that Spain is actually doing a lot better is because the Prime Minister there has imposed a very severe austerity program and has basically stuck to the program. So it's almost like markets are actually now starting to price accordingly, and actually viewing those austerity programs, if they're implemented, as actually a positive thing for bond yields and credit metrics associated with sovereign debt.
I don't want to get, I know we want to keep the focus domestically, but it was interesting, you know, staying in Europe just briefly, Sally, you know, Greece was actually shut out of the bond market, as we know, and there's been no word still yet, as far as I know, of further plans to issue debt. But are you persuaded that their austerity measures are going to pass muster?
Yeah, so far so good. I mean, basically the IMF is in there and they're all over the Greeks and their public finances. So, I mean, basically the Greeks have no choice except to do what they're told by the IMF and actually stick to the austerity program. And we sort of don't have to worry about Greece for, another 2 years. They are fully funded out until the end of 2012. Now, you can ask some interesting questions about what happens next, but, from everything we read and everything we sort of see, our own research at JP Morgan tells us that things are proceeding as they should in Greece. And I guess that's a near-term positive, but you can own sort of 18-month or 2-year Greek paper and it pays you a pickup of almost 1,000 basis points over German paper, and our European rate strategists sort of argue that basically there won't be a default in the next 2 years because we know that Greece is already fully funded. So, for investors who are looking for yield in that sort of environment, our guys view sort of short-term Greek paper as a pretty sensible overweight because it offers such a high pickup to German bonds, and you don't need to worry about the prospect of a restructure or default for at least another 2 years.
And Kieran, again, let's try and bring it back home. So Treasury market's obviously looking at that issue of the European debt. That's something that's ongoing. You've got the quantitative easing issue, and whether that gets dealt with tonight by the Fed Reserve. Is any of that or all of it going to impact the RBA when it's making decisions?
I think the RBA has been pretty clear about focusing on the domestic economic situation, and yes, the international scene is still fragile, and it's still an important backdrop. However, I don't think it's necessarily, unless something untoward really happens and the house of cards falls over completely, I don't think the governor is going to veer from the path he's directed at this stage.
Even if they reinstated quantitative easing, it wouldn't put them off track in terms of tightening monetary policy?
It depends on the statements and etc. about the fragility of the economy in conjunction with that, but no, I don't think so.
Because it's been said, that Stevens has been, and we were just having this remark made earlier, very good at managing expectations. How do you judge that achievement when it comes to Bernanke? Has he kind of got sort of the A star from you on that one, or what does he need to do better now to cement confidence?
I think he needs to continue on the path of building confidence, and that essentially is supportive of continuing to do what he's previously said he will do, which is everything required to to grow the economy a little bit stronger.
And the other interesting aspect of this as well, to having you guys on today, is that we watched that S&P 500 index go above 1130 and people saying this is the breakout, this is the real deal. Sally Old, I guess the question is whether you see money come out of bonds in order to, participate in this next breakout for equities, or can we see both rally together?
Yeah, I think we can be in an environment where we see, at least for the near term, bonds do well and equities do reasonably well together. I mean, I think what sort of fueled the rally up to now is probably short covering in equities. People were short and they didn't really get the huge sell-off that they expected, so they're covering those positions. But, pretty much every good rally starts with a short covering rally. So, the technical break's obviously pretty important. But I think, once we get the FOMC out of the way in the next 24 hours, I think we're going to be in an environment with sort of sub-trend growth for the next little while, with the Fed on hold, with the potential for more disinflation. That's going to be a pretty supportive environment for US Treasuries. And of course, I guess the additional dynamic that's happened in the last week is the Japanese intervening in the currency markets. And all other things equal, that basically means, another source of demand for US Treasuries. So we remain very constructive on US Treasury yields, over the next 6 to 9 months. And although near term we're a little bit worried about some of the supply dynamics and obviously what might happen with the Fed early tomorrow morning, but I think, pretty much anywhere around that sort of 2.75 to 3% level on 10-year Treasuries, it looks like a pretty good buy given the overall macro environment. Now, you can sort of say that slow growth and disinflation isn't great for equities either, but on long-term valuation metrics, they still look pretty cheap. And I sort of think, given fears are sort of receding about the prospect of a double dip, maybe that's going to encourage at the margin more people into risky asset markets. So I can see a scenario where you do get sort of good equity performance and good bond performance for the next little while. And in fact, that's exactly what happened. If you look back to the deleveraging experience that happened in the Scandinavian economies in the late 80s, early 90s, exactly that. GDP rebounded, equities did well, 10-year bond yields fell. So it can happen.
You know, so there's been a bit of criticism, though, and maybe Kieran as well, you can come in on this one, that we're actually almost, in a sense, putting too much emphasis on the role of central banks now when it comes to riding this one out, and it should be the role of governments to develop policies to foster, like in Japan, consumption. In the same way as in the US consumption is slowing, there aren't signs of credible government policies from that side of the fence to boost that sector. Sally?
Well, I mean, I guess that, the government's done, a lot basically over the last 2 years, and really, there's some analysis recently from Alan Blinder basically saying, were it not for some of the initiatives of the US government, the unemployment rate would be at 16%, not 9.5%. So I don't think we should be too harsh on government. They have had quite a lot to do, but ultimately all they can do is put in place, I guess, the sort of framework to encourage an economic recovery. And we've got to remember that part of what's going on in a lot of these Western economies is that we're having a rebalancing of the economy away from debt and away from consumption towards sort of exports and investment-led growth. So we're looking at, higher savings rate, lower consumption growth rates. And again, if you go back to that Scandinavian experience in the late 80s, early 90s, household deleveraging took 6 to 7 years to play out basically before it was done. So to the extent that, for the long-term macro stability of the US, that's what we want. I'm not so sure it's the smartest thing for government to sort of be in there encouraging consumers to let loose and spend willy-nilly right now.
Thank you so much to both of you guys. We run out of time for now, but Kieran Quain from FIG Securities, thank you, and Sally Auld from JP Morgan in Sydney. Thanks for your time as well today, and Carson in studio.